We'll dig into a few of the basics about futures and how they work. Next, we'll walk through a speculative trading strategy. Then we'll show you how to place a basic practice futures trade on the thinkorswim paper money platform. Futures aren't for everyone. The futures market can be fast-moving with a high degree of risk, so education is essential for anyone interested in trading it. Before trading futures with real money, traders at Schwab must have a margin account with futures approval, but you can use the paper money simulated trading platform to practice trading futures anytime without actual cash. Let's start with some definitions. A futures contract is an agreement to buy or sell an asset at a predetermined price at a specified time in the future. It's what's called a derivative because the contract derives its value from an underlying asset. This allows traders to use futures to speculate on the price movement of things like commodities or stock indexes. In this video, we're going to focus on trading futures on the S&P 500 stock index, which can allow traders to potentially profit from price changes in the S&P 500 without having to buy all the stocks in the index. The contract we'll look at is the Micro E-mini S&P 500 Index Futures, which is traded using the symbol /MES. Futures can offer traders some advantages. For example, futures can be traded close to around the clock. Different types of futures products have different trading hours, but at Schwab, clients can trade /MES futures from 6 p.m. Eastern Time in the US all the way until 5 p.m. Eastern Time the following afternoon, Sunday to Friday. This allows traders to react to global events outside of US stock market hours. Futures also offer traders leverage, which lets them use a relatively small amount of capital to trade a large position. That capital is a good faith deposit called the initial margin requirement and is the amount of cash you have to initially commit to enter a futures position. Leverage on a futures contract comes from the fact that the initial margin requirement is usually a fraction of the notional value of the contract. Futures have a smaller initial margin requirement than stocks, and there are no intraday trade limits. Keep in mind that although the initial margin requirement is typically lower for futures than for stocks, futures don't offer some of the potential benefits of owning stocks, like voting rights or dividends. Additionally, futures contracts expire after a set period of time. Because traders can use that little bit of money to enter a large position, small changes in the underlying can translate into large gains. However, the opposite is also true. Leverage can magnify losses quickly and with smaller price movements.